Let's get to 1,000 subscribers. Please help support Joni and our team by subscribing and turning on notifications.
Hello everyone, welcome to Market Rising, where we've got breaking news from two major markets, Asia and Europe. We'll dive deep into Alibaba's eye-catching AI investments, discuss the challenges facing BYD and Meituan, and explain why Morgan Stanley sees Ferrari as a top stock for our time. Get ready, because today we have good news, bad news, and crucial insights every investor needs to know. Let's get started. Joy Up Invest Podcast. Invest better every day. Hello everyone, welcome to Market Rising, the show that brings you the latest updates on the Asian and European stock markets from the past week. Let's begin with Alibaba. The Chinese tech giant we all know well just released its Q2 2025 results. Revenue increased by 10% to 247.7 billion yuan, which is decent. But what's really interesting is that adjusted EBITDA decreased by 14%, while GAAP net profit actually soared by 76%. Let me quickly explain. Adjusted EBITDA is a measure of a company's core operating performance before accounting for interest, taxes, depreciation, and amortization. GAAP is an accounting standard that includes special items. The fact that adjusted EBITDA fell while net profit rose shows that Alibaba is undergoing a major restructuring. The company is heavily investing in new technologies while also selling off non-core assets. This is a common strategy for many tech companies during a transition. What excites me more than the numbers is Alibaba's big investment plan. The company announced it will invest 380 billion yuan over 3 years in cloud and AI, which is a massive 1.6 trillion baht. This huge number clearly shows Alibaba is serious about the future of AI. CEO Eddie Wu also said that AI's transformative impact on every industry will be the most significant opportunity in the tech sector over the next decade. This isn't just talk. We're already seeing Alibaba use AI in every part of its business, from warehouse management and demand forecasting to creating marketing content. From a long-term investor's perspective, I see this investment as laying a critical foundation for Alibaba to compete in the new era. However, you should be aware of rising costs, especially R&D expenses, which may pressure short-term profits. In a 5-10-year view, though, this investment could make Alibaba a leader in AI for the Asian region. Another thing to watch is quick commerce, or instant delivery, which has grown by 200% in monthly users to 300 million people. This is a new trend where consumers want goods delivered as quickly as possible, sometimes in just 30 to 60 minutes. Alibaba aims to add another 1 trillion yuan in GMV, gross merchandise value, from quick commerce over the next 3 years. The growth of quick commerce shows a fundamental shift in consumer behavior, especially among younger generations who expect instant delivery. Companies have to invest heavily in mini warehouses, dark stores, AI systems for inventory management, and a network of delivery workers. These costs are high, but create a strong moat for those who can do it well. From an investment point of view, quick commerce is capital intensive, but once established, it has a powerful network effect. The more users you have, the better you can negotiate with merchants. The more data you have, the better you can improve the system. This is why Alibaba is willing to sacrifice short-term profits to invest in this business. Even more exciting for investors is the news that Alibaba recently launched new AI chips that are made in China, not in Taiwan's TSMC as before. This shows China's effort to reduce its reliance on foreign technology, especially after the US restricted exports of advanced NVIDIA chips to China. The fact that China can now produce its own AI chips is a significant event. While they may not be as advanced as TSMC yet, it shows China's goal of achieving technology sovereignty. Over the long term, 5 to 10 years, if China can produce its own high-end chips, the impact on Taiwanese and South Korean companies will be significant. For long-term investors, you must understand that the semiconductor competition is entering a new phase. Companies that will survive must have a deep technology moat, continuous R&D, and strong relationships with their customers. Now, let's look at a truly hot stock right now, Cambricon. This stock has soared to a new all-time high, up over 100% in August alone. I bet anyone who bought it at the start of the month is very happy. Cambricon is a Chinese AI chip company gaining attention as Beijing pushes Chinese companies to use domestically produced chips. The company reported a record-high profit of 1 billion yuan in the first half of the year, while revenue surged 44 times from a low base. This kind of growth makes us ask if it's sustainable growth or just a short-term boom. I think in the short term, Cambricon is benefiting immensely from Chinese government policy. But in the long term, it needs to prove its products can truly compete with foreign rivals. For investors interested in Chinese AI stocks, you must understand this is a high-risk thematic investment. Your investment should be a small part of your portfolio, and you must be ready for high volatility. However, if China succeeds in building its own AI ecosystem, the long-term returns could be very high. Meanwhile, China's electric vehicle giant BYD is facing challenges. For the first time in over 3 years, its Q2 profit dropped by almost 30% to 6.36 billion yuan. The main reasons are a slowdown in the domestic market and intense price wars in the EV industry. BYD has already sold 2.5 million cars in the first 7 months of the year, but it's still far behind its 5.5 million target for the year. The Chinese EV industry has now entered a mature phase. Instead of growing by 100 to 200% per year, it's now growing by 20 to 30%, which is a natural adjustment. Fierce price competition is squeezing the gross margins of every company. But this is also an opportunity for strong companies like BYD to push smaller rivals out of the market. From a long-term perspective, BYD still has several strengths. First is its vertical integration. The company produces its own batteries, control chips, and has a complete supply chain. Second is its strong brand recognition both domestically and internationally. Third is its innovation pipeline, with continuous development of new battery technology. This quarter's profit drop might be a good entry point for long-term investors, but be aware that the price war could last for a while. I recommend looking at market share and unit economics rather than just the profit numbers. And finally, Meituan, the food delivery giant, is in serious trouble. Its stock fell 11.2% after reporting a 97% drop in Q2 profit to just 365 million yuan. The main reason is fierce competition in the food delivery business, which the company called irrational competition. It had to increase promotions, hire more staff, and raise wages to compete with rivals like Alibaba's Ella.me and JD.com. Meituan's situation is an important lesson for investors. Although the food delivery business has a network effect, it also has low switching costs. Consumers can easily switch apps for a better promotion, making it hard to build customer loyalty. The 97% profit drop shows that in a price war, the biggest loser is the shareholder, not the consumer. For long-term investors, you should wait for the market to consolidate or for a regulatory intervention to stop the price war. I believe Meituan is still the market leader and has a broad ecosystem beyond food delivery, including hotel bookings and travel services. But in the short term, 1 to 2 years, its profitability will continue to be pressured by competition. And that's the situation with Chinese stocks. But when we talk about changes in the Asian market, it's not just China facing challenges. The Indian market is also under pressure from news about tariffs. This morning, Asian stock markets fluctuated with news of increasing international trade tension.
India's Nifty 50 index dropped again after the US raised import tariffs to 50%, reaching its lowest level in 2 weeks. The main reason is that the US increased tariffs on several Indian goods, especially textiles, gems, and jewelry, which are the core of India's export economy. The 50% figure sounds like a lot, but it's actually an accumulation, starting from 25% at the beginning of the year and adding another 25% in August.
What's interesting is the reason behind this tariff increase. US officials said it was in retaliation for India continuing to buy cheap oil from Russia, which is a mix of politics and economics. However, my long-term view on India remains bullish. The country still has a long-term demographic dividend, with a growing working-age population, continuous digital adoption, and a clear government policy to support Make in India. Over the next 3 to 5 years, I expect India to become an important manufacturing hub, especially for companies that want a China Plus One strategy. Investments in infrastructure and a digital India will drive long-term growth. I think in the short term, the Nifty 50 index may face continued pressure, but in the long term, India remains a strong growth economy with a young population and advancing technology. In terms of support and resistance, 24,500 is the key support level to watch. If it breaks down, it might test the next support at 24,000. But if it recovers, the resistance is at 25,000. For long-term investors interested in India, I recommend looking for quality names in sectors that benefit from domestic growth, such as banking, technology, and consumer discretionary. But you should be careful about the high valuation levels. Now that we've covered the Asian market, let's cross over to Europe. While the overall picture might seem sluggish, there are still hidden gems to be found. In the tech market, Barclays released a report warning that semiconductor equipment companies are facing risks from China. WFE, or wafer front end, refers to the early stages of chip manufacturing, like laying the foundation of a building. Barclays expects WFE spending in China to drop by 5% in 2025, before recovering by 5% in 2026. The big concern is that Chinese companies are increasingly replacing imported tools with their own domestic ones. This means US companies like Lam Research, KLA, and Applied Materials will lose market share to Chinese competitors like Nora and AMEC. This trend of indigenization, or using domestic technology, is a long-term trend that investors must follow. It's not just in China. Many countries are trying to reduce their technology dependency on foreign nations. For investors holding semiconductor equipment stocks, you should be prepared for a structural shift that could permanently reduce demand from China. But there is a bright spot. ASML from the Netherlands still has a strong position in lithography technology, which is the process of printing circuits onto wafers. This technology is so difficult that China cannot replicate it in the short term. I think the semiconductor equipment sector will continue to be volatile, especially for US companies facing pressure from both export controls and Chinese competition. But for ASML, things may be better than for its peers. ASML has a very deep technology moat. Their EUV lithography machines use technology so complex that hardly anyone else can build them. They also have steady service revenue from maintaining the machines they've already installed. Over the next 10 years, I believe ASML will remain an essential player in the chip manufacturing supply chain.
Let's move on to something beautiful. JP Morgan says the global beauty market is still slow, but they recommend two interesting European stocks, Beiersdorf and Unilever. Beiersdorf is a German company that makes cosmetics and skincare products, like the famous Nivea brand. Its PE ratio for 2026 is 21x, which looks attractive as the global beauty market slowly recovers. Unilever is also interesting because it is restructuring its business to focus more on beauty and personal care. The beauty business is a great defensive growth sector. Even when the economy slows down, people still spend money on beauty, especially affordable luxury products like basic skincare.
The growth of social media and influencer culture continues to drive demand for beauty products. For beauty stocks, I think this is a good long-term investment because people will never stop caring about beauty. The aging society trend also fuels continuous growth in the anti-aging and skincare markets. However, be aware of strong competition from K-beauty and fast-growing Chinese brands. What's also interesting is the change in consumer behavior. Younger consumers prefer brands with sustainability and authenticity over traditional brands. Beiersdorf and Unilever are adapting by investing in natural ingredients and sustainable packaging, which are necessary long-term investments. Today's highlight is the news about Ferrari. Morgan Stanley just added it to their MAPS Global Equity list, replacing Fomento Económico Mexicano, FMX. This decision shows that the luxury market is still strong, even with global economic uncertainty. Ferrari generated 6.7 billion euros in revenue in 2024 by delivering only 13,800 cars. Think about that, almost 500,000 euros per car. This is the power of true pricing power and brand value. Ferrari customers aren't just buying a car, they're buying status, a dream, and a heritage built over 75 years. What makes Ferrari different from other car manufacturers is that they aren't in the transportation business, they are in the dreams and status business. Scarcity is a key strategy for Ferrari. The company deliberately produces fewer cars than demand to maintain exclusivity and resale value. What's also interesting is that Ferrari's order book is almost full, and demand for new models remains strong. This means that even if the economy slows down, the wealthy are still buying Ferraris because for them, a Ferrari isn't a necessity, but a desire and a status symbol. A midterm catalyst coming soon is the first all-electric Ferrari, which will be launched soon. This could be a major turning point because the luxury EV market has few players. Ferrari's entry into the EV market will help expand its total addressable market, especially in places with strict emission laws. In addition, Ferrari is also expanding into a lifestyle brand, with Ferrari restaurants, art galleries, and even theme parks. Building this 360-degree brand experience helps increase revenue from sources other than just car sales and creates deeper customer engagement. From a long-term investor's point of view, comparing Ferrari and Tesla is interesting. Tesla sold 1.8 million cars in 2024, generating about $96 billion, which is about $53,000 per car. Meanwhile, Ferrari sold only 13,800 cars, but earned almost 500,000 euros per car. This shows that the two companies' business models are completely different. Tesla focuses on scale and efficiency, while Ferrari focuses on exclusivity and premium. In the long term, I think both brands can coexist because they cater to different customer groups. For the long-term luxury market, there are several positive factors. First is the rise of wealth inequality, which means the rich have more money. Second is the growth of new money in Asia, especially in China, India, and Southeast Asia. Third is the experience economy, where people are willing to pay more for unique experiences. Looking at the technical side, Ferrari stock has been trading between $400 and $500 per share since the beginning of the year. The expected PE ratio for 2026 is 39x, which is in the middle of its 3-year range of 30 to 50x. Is it expensive? Absolutely. But for a luxury brand with this kind of pricing power, paying a premium is normal. The key support level is at $400 and resistance is at $500. If the stock can break out above $500, it would be a positive signal for the medium-term price direction.
The European market is currently facing a triple challenge. First is energy security after the war in Ukraine. Second is its declining competitiveness compared to the US and China. Third is the demographic challenge from an aging society. But Europe also has significant strengths: innovation and quality that remain global standards, especially in the automotive, chemical, and machinery industries. The fact that Europe has a Green Deal and strict environmental laws could become a long-term advantage as the demand for eco-friendly products increases globally. For long-term investors, I recommend looking for European companies with a global presence and technology leadership in their specialized industries, such as ASML in semiconductors, SAP in software, or LVMH in luxury goods.
In summary, today we've seen both risks and opportunities. The Asian market is being affected by trade tensions, but there are also quality businesses in Europe worth looking at. Investing in this period requires you to look at a business's quality, brand strength, and ability to control its pricing rather than just guessing the overall market direction. Investors holding Indian stocks should closely follow the trade talks between India and the US. As for those interested in European stocks, don't forget to watch for Ferrari's Analyst Day on October 9th, as there may be new and interesting strategies announced. Until the next wave, my friend, let's keep following the market together. And don't forget, the best investment is one you understand. Understanding the business, understanding the risks, and understanding yourself. And remember, everything I've shared today is just my personal view, not investment advice. So please always do your own research, think it through, and keep in mind, investing always carries some risk. Before we call it a day, don't forget to like, share, and hit that notification bell on JoyUp Invest so you'll never miss our daily bite-sized insights from markets all around the world. Now I'm curious, what stocks are you holding right now? Go ahead, drop a comment. Let's talk about it. All right, that's it for today. Catch you in the next one. Bye!